Let's talk about all of that with somebody who's seen a lot of cycles in the market, Rajesh Kothari, whose PMS is doing phenomenally well and growing. Rajesh, good afternoon. Thank you so much for your time. How was your interaction with your investor fraternity last 6 to 8 weeks? Many of them, I assume, would not have seen, as in, would have actually joined you in the last 20 months. So this corrective phase, what are the kind of queries you were having?
Rajesh, is always nice to interact with you, and I see that in every interaction that you bring the different kind of topics on the for discussion from viewers' perspective. So I think what is happening is that last 12-18 months, particularly April, May, June, July of current year, were actually the most HNI investors. While they were bullish on market, they said market is like just going one way up, and they were not able to get actually good entry price. And our view is very clear that there will be correction at some point of time. Nobody can time the market. So in a way, this 9-10% correction from the peak is actually a very healthy sign for the market. And if you ask me, then we are actually seeing good inflows, top-ups from our existing investors. The fear of pandemic wave 2, which was there in April, June, of course, they've gone away. The new Delta variant, the people know that, there are no major casualty. There might be more transmissible, but not a major cause of concern. So I think the bad part of the macros, whether it is a supply chain disruption, slowly is easing out. Inflation, which has become a hot topic for the entire market in the world economy, there is also, probably showing initial signs of a little bit cooling off, which is also a good thing. And the market correction, I think it is also timely. So I think, from initial perspective, they are becoming now more positive compared to what their view were about maybe 2-3 months back.
Right. Rajesh, what have you been researching lately? I remember that, last we spoke, you were talking about, the next phase of growth coming in some of the large chemical names, industry leaders like Aarti, etc. After one phase of growth was over, that went well. Are you topping up, or did you top up your earlier favorites in your portfolios last 2 months, or are you closely looking at some area? Give us some feedback on the study which you're conducting.
I think, Ajay, what we have done is that post this second quarter result, I always believe that inflation is an acid test for any portfolio. If for instance my company is good, how they have faced this such a hyperinflation, how they have faced such a hyper supply chain bottlenecks, how they have faced the freight index moving up from 1,000 to 5,000. It's not an easy number. These all are like 20, 30, 40, 400% kind of increase in certain commodities and freight index. And what kind of a growth, what kind of a cost resilience the portfolio companies have demonstrated is something very, very important. Correct? So good amount of time actually we spent post second quarter in terms of analyzing what is happening to the corporate India, how resilient corporate India has behaved in terms of the pricing power and in terms of the cost mitigation. And we are very happy. In fact, in the very recent Triple Insights, we have talked about it in detail. Most of our portfolio companies, they actually passed with flying colors on 2 counts. One, absolute revenue growth, absolute EBITDA growth, and absolute net profit growth. And second, compared to their own peer group, how they behaved in terms of the pricing growth and the margins. In fact, our portfolio companies reported net profit growth is almost 30% compounding compared to a normal second quarter of pre-COVID year. So I'm talking about a 100 index has become 160. Of course, the economy has not grown from 100 to even 120, forget 160. So that shows the underlying resilience of our portfolio companies. And across sectors, whether it is our building material segment, which we are talking about probably in our last interaction also, I mentioned about it, they've done extremely well. Whether we look at our auto ancillary basket, again, they've done extremely well. The last 3, 4, 5 months, incrementally, we are talking about our capital goods exposure. This was the theme on which we were not so positive, maybe for last 5, 7, 8, 9 years. But incrementally, in the last 6 months, we have deployed more money to capital goods sector. And here again, our composition of capital goods is completely different compared to what normally people think about capex. So it is not about infrastructure, it is not about power, it is not about the giant thermal equipment, the things have changed. And we are focusing on the companies which are more technology driven, the product more, the technology more. So I'm talking about multinational companies having subsidiaries in India, where they are very strong, parentage from the technological backup, correct? And those kind of the companies I'm talking about. So we have added weightage to those companies, which are of course doing phenomenally well. So that's basically the areas where we are investing on incremental basis. Specialty chemical, one point you raised, we remain very bullish on specialty chemical. And very important is that there are two kind of chemical companies. One is commodity company and second is specialty chemical companies. The commodity companies have done extremely well because the prices of the finished goods, it went up by almost 200-500%. But the consumer of such commodities, which are specialty chemical, they have actually not done that well because of the hyperinflation. But from this quarter onwards, we expect now specialty chemical, real specialty chemical companies, like the one which you mentioned in your interaction, we believe that those kind of companies now will get more benefit as the raw material pricing cools off and also as they pass on more such price hike to their consumers. That's the kind of a trend what we see from the overall portfolio perspective.
Right. Rajesh, if you could, after the second quarter numbers are done, I know you cast your net quite wide and study way larger companies than you own to understand the trends. But the two strategies which you are running, if you could tell us about the updated, 12-month far out numbers, which the estimated forecasted earnings, which both your portfolios are actually showing now after this quarter is over. How does the picture look?
I think both are we have three strategies: triple India opportunity plan, focus plan, and mid and small cap plan. And all three portfolios are probably in FY22 as well as in FY23. They are looking at 22-23% growth, and in many companies we are going to see even 25-30% growth for FY22 and FY23.
Oh, that's very nice. So, if you could, I'm getting greedy to know what is the composition, where is the highest earnings growth coming in, what kind of teams are throwing up better growth prospects on earnings?
So one is of course, this entire space of specialty chemical companies, because good amount of capital expenditure is done by these companies, and as and when that gross blocks comes into the commencement of operation, you will see the incremental revenue growth because of the capex which is done, and that journey continues for another 3, 4, 5 years. So that's the one block that is going to give us 20-30% compounded earnings growth over next 2-3 years. Second is the building material space, everything is in your favor, and I'm sure you are aware that we buy only the companies which are like monopoly or oligopolies. They are really large companies within the building material space, and they are disproportionately gaining market share. So improvement in real estate demand, consolidation of the market share, unorganized to organized, within organized, closure of many small players, all this adds to their revenue growth. Margins are anyway resilient, and they will also deliver very strong earnings growth. Third important segment is the capital goods segment, where probably earnings are a little bit what I would say back-ended. That it's more of an order book growth, and that segment is also going to do extremely well because they are also changing their revenue mix to short-term order execution rather than 3-year, 5-year order book execution. So that segment is also going to do very well. Banking and finance, the last one, which is of course a good part of our portfolio. You have seen the impact in FY21, partially in FY22. Base is going to be in your favor, so even that segment is going to report, the good growth. So this is how we see. But Ajay, let me also tell you that last 12-18 months it was more like a top-down market. Everything went up. I think next 12 months are going to be different. It is not going to be top-down. It will be more of a stock selection approach that will be more rewarding to investors. There might be consolidation in the market. There might be some correction in the market. Overall trends remain positive, but bottom-up approach will be more rewarding rather than top-down approach, in my view, since we have already seen significant gain in last 12-18 months.
Right. Rajesh bhai, before I let you go, just one quick word as on the last point which you said. So first, a sharp rebound from an extreme point of pessimism, usually everything rises. That tide lifts all boats, which you said, and it is a great time for momentum traders also. Anything you buy goes up. From here, it will be very uh, backed by earnings only. So is it prudent for investor community that over 12 to 24 months they should also temper down their return expectations because it will not be a widespread bull market perhaps?
Yeah, Ajay, I completely agree with you, and I don't know what expectation investors have, but I think equity market as an asset class, it is safe to assume, 10, 12, 15% kind of a compounded returns over next, 3, 4, 5, 7 years. Few years you will see very extreme bull market, few years you may see one or two very bad market, and then the other years basically are average years. So on a compounded basis, that expectation, no major change in it. But considering last, I mean, of course, one cannot say next 12 months again we will see 50% increase in Nifty. It will be foolish to assume that. But can we still deliver much higher return compared to other asset class? Definitely, that's the potential, and there's no doubt about it. So yes, the tempering down of expectation is to make it more realistic is definitely need of an art. Markets will remain volatile. Corrections are part of any bull market. Don't worry too much about it. Don't try to time the market because you may not go right every time. And invest in the good quality stocks with a good earnings growth. Many companies have not delivered earnings growth. Let me tell you, many companies have not delivered earnings growth. So what is important is the stock selection from here on is going to be very, very critical if you want to actually make money and create wealth in the medium to long term.
Yes, always wonderful chatting with you. Thanks so much for your time today as well.
Thank you, Ajay.
That was Rajesh Kothari of AlfAccurate, very experienced voice in the